Salute, y'all. Y'all know what it is. Y'all know what to do. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, your social media insurance broker. So today I want to go into a private Facebook group that I'm a part of, and instead of using the genius of some of these other agents, I'm going to use my own genius. So here's something that you, the general public, or if you're a financial professional who may be new into the industry and don't understand fully or have enough experience of the industry to understand these things, I want you to take a look at this thread. So it's my thoughts on buy term, invest the rest. And you can use this against CFPs, CPAs, all these people who have all these word salads but don't have things like CHFC or MDRT in their title. So my thoughts on buy term, invest the rest. I think it's a good idea, but flawed in execution. The truth is, I agree, nobody should be paying for life insurance for their whole life. However, they should have whole or permanent life insurance. Hence why there is limited pay life. Did you know you can schedule your client's whole life to be funded similar to a term, meaning they only pay into the policy for a fixed period of time and then payments stop? Something you may want to say when with a Primerican and you're discussing. Now, I'm going to show all the comments here because there are a lot of people who commented on this, and there are a lot of knowledgeable agents who have commented on this. This woman says, I agree. I just set up a client to pay for a whole life insurance policy up in 20 years because who wants to be paying for life insurance when you're old and retired? This gentleman says, I kind of like when I pay $8K for the base premium and the cash gap value goes up by about $15K. Do I have to keep doing that? No. However, I will for as long as possible until I decide to do something different. This agent says yes. This is what I was referring to earlier. The returns after a long period of time are exponential, with a paid premium resulting in a cash value increase of 2 to 3 times said premium. People can go paid up at any time, but plenty of people prefer to keep paying premiums and increasing the cash value every year. Then this agent says it can work either way, with a paid up date or a lifelong funding. The premium is level, so the growth in the cash value relative to the premium paid will only increase year over year. It's not a loss for the client to make a lump sum 6K payment and gain way more than that in cash value. For example, the paid up option is cleaner for people who want the predictability of expenses in retirement and don't expect to access the growing cash value anytime soon. As with all things, it really depends on what fits the client's circumstances. And this agent says, but an insurance policy or any combination thereof, term, whole life, IUL, does not constitute a complete retirement plan. In my opinion, there should be an investment portion. And I responded, well, it's like wheels on a car. You need all four for it to go. However, this post is more focused on just the one product. I appreciate the input, as agents who aren't as experienced as us may take the original post as the gospel. Then this gentleman says, agreed. I personally used to think the IUL was the answer to everything. And I responded, well, the IUL is still my favorite product, but it's not always the best for most people. I generally do a low-cost one for close friends and families, explaining they'll be increasing the premiums in the near future. But for clients who aren't family, especially those who want to take advantage of certain strategies, I explain it's going to average about $1,000 a month. I always show them my commission on how I set it up versus target, and then they end up putting more in. True, insurance will be the foundation and part of the portfolio of financial solutions. Then this agent, who is very much an expert, I'm learning a lot from this gentleman, says, not necessarily. Depends on one's risk tolerance, time horizon, current assets, liabilities, income, expenses, plans already in place. If I have a 65-year-old still working who wants to push 5 more years, describes themselves as risk averse and rates a 1 out of 10 on risk tolerance, has market concerns, more than enough in reserves, no liabilities, and has other assets in place, and they state preservation of capital is their primary concern, why would you put that person in investment? Furthermore, life policies are not intended to be one's full retirement plan. They can be used to supplement, and if they have a good cash value where they can draw down on it over time, ideally, yes, they should have other things in place. But that doesn't necessarily have to be an investment. Someone says, no arguments there. I just hate when I see agents trying to get all of the client's dollars into life products only when they're young. Unfortunately, some people only know life insurance products and have very limited skill sets. Many don't hold securities licenses or don't work in a fiduciary capacity. They're often not legally or ethically held to a higher standard. They may be unaware of what else may be out there and how it all ties into their overall financial picture. They could also just be unethical agents, in which case it's a matter of time before they get weeded out or their clients get taken by actual professionals. This is why I advocate for constant learning and development, becoming well-rounded and mastering the craft. This is often the result of people only having a life license and people staying in their comfort zone. So many people are showing up to the job site with an empty toolbox, only carrying a hammer. Thus, everything becomes a nail. Life insurance becomes their answer for everything. Taking all the excess dollars and not doing proper planning usually leads to higher lapse rates. They're completely unaware that if they just learned other tools, they could build stronger and greater futures for their clients by mastering the other elements. They'd actually learn how to use life products more effectively. Now, here's why I think buy term invest the rest philosophy is a terrible idea. They are banking on their investments to perform at a certain rate. They're also banking on their health being good in the future. Financial lives are dynamic and ever changing, not static. Say their term runs out, they develop a severe condition and are no longer insurable, and their investments end up tanking. That person is in a far worse position. Now, if that person passes, their risk exposure may be much higher. Their family may not have the funds to ensure everything is taken care of. By adopting that strategy, they screwed their client over. I have seen this play out in real life. I get everyone wants to chase potential gains, but proper risk management is a part of a firm foundation. Term is greater to be cost effective in the short term, but whole definitely has a place and greater benefits that can be strategically leveraged. If your only concern is a fixed expense like you don't want your family to get stuck with a mortgage, then yeah, get term. But if you want to leverage the tax benefits, build up cash value, and want to protect your future insurability, get whole. And then this other person says a 10 or 20-year paid up life policy will be more premium per month, but less premium if you live a normal lifespan. This is true. However, a 10-year term may cost $5K over the course of 10 years, and then cost $5K for year 11 alone as an annual renewable term. Not negating what you said, just adding context. And then Mr. Kramer again coming through with the hard-hitting stuff. I thought I was hard-hitting, but he's hard-hitting too. All you're doing is condensing the amount of time. Some people have the means to do it, and for some it's a solid recommendation. Here's a scenario where it may make sense. Say someone is 30, very healthy, makes really great money. He wants to ensure his health rating is locked in for life, and that he always has coverage no matter what. He also values tax-free growth, but makes too much to contribute to a Roth IRA. He's not a fan of munis, municipal bonds, and he wants a place to park his money while getting some tax-free growth that's not tied to the market. He likes the idea of leveraging cash value dollars, but doesn't want to wait too long to have access to higher amounts. In this case, a 10-pay will make more sense. Yes, his premiums will be higher, but the cash value buildup will be sooner. By the time he's 40, he never pays another dime into it, and he's covered for life. Now, if he does live to 100, it's had 70 years to compound, and now it has far more than he initially put in. It's not for everybody, but for those who can, it'd be a great tool. Then this gentleman says, nobody should be paying for life insurance their whole life, however they should have whole life insurance. Laugh, laugh, laugh. I said, I get that it's funny, but you do realize permanent or whole life doesn't have to be paid for the entirety of one life's. Have you ever heard of limited pay? And then Mr. Kramer says, that's why you do a limited pay or do a full whole life, then pop the policy when the cash value buildup is high enough to take care of the premiums. Don't overthink it. And obviously, Mr. Kramer is securities licensed. For me, the only way to structure a whole life policy when the idea is cash value. Someone here says 95% of people in America want retirement less than with retirement less than $1 million in assets, or less than $100,000 a year in retirement. Most people don't understand the mass of the retirement, and they overpredict what they're capable of retiring with based on their desire rather than the reality of math. You always want to get an unlimited pay policy, whether it be 10 or 20 years on children, an early age, to maximize the amount you can get on the child versus the overall premium. Most people don't plan for generations. Most people overlook their children whenever they purchase a whole life policy. Do you get term and invest the rest, or do you get a whole life policy? The best answer is you do both. And then lastly, this agent, she says, I see where you're coming from with buy term, invest the rest, and its strategy that has merits. But one thing many people overlook is that term insurance eventually expires, leaving clients potentially without coverage when they might still need it. That's where limited pay whole life shines. It bridges the gap. You can structure it so your client pays premiums only for a fixed term, like 10, 15, or 20 years, and then is fully funded from there. They maintain lifelong coverage and have cash value growth without paying another dime. It's like having the cost effectiveness of term insurance, but with the added benefits of permanent life coverage. Have you looked into this option when working with clients who want long-term security but don't want to pay premiums forever? And so here you have it, ladies and gentlemen, a bunch of agents who, unfortunately, you've got these, fake ass investment gurus who are telling you to buy Forex, but don't tell you about a $25,000 margin account or options, right? And you're investing, but they don't tell you generally 25K is the minimum you can invest for the federal government to even consider it. At least 10,000 is the minimum, because they need to fill out this thing called an SAR, which is a suspicious activity report, which most of these fake ass investment people don't know about. But make sure you share this with your close people and anybody you know, especially if they're talking about investing in options or Forex or investing in general, especially things like crypto as well, because they don't understand the strength and power of life insurance. With that being said, wipe ass, work in progress every day, and see success. Salute.